So, so the objective today of this seminar is for you guys to have a basic understanding of how a mutual funds work. So the basic concept, etc. So actually, maybe from the investor point of view first, before we talk about even fund report, etc. But I think it's important to understand the basic before then we can understand the reports. And then after that, we know, what is important to extract and what kind of service we can provide to our customers who are working with those reports. Okay, I think even beyond the work itself, understanding mutual funds is very important for you guys, because it's very important way of saving money for people. And mutual funds personally helped me a lot when I was a junior, to buy a house, because save money, and then after that you use it to, etc. So it's actually important, even beyond the work itself. Okay, so for you, from a personal point of view. So I think it's good that you understand how it works. Okay, so let's start. So what is a mutual fund? So a mutual fund is actually a company. Okay, so it's a company, or you can call it also an investment vehicle. So it takes the money from many investors together, pull it together, and then by a fund manager, and then the fund manager is going to invest this money into financial securities, financial products, such as stocks, bond, or short-term debt, etc. So the financial investors, the fund managers, he doesn't use his money, he uses your money. If you are buying the fund, the money from all everyone, and then together he's going to make a decision for everyone and to buy these stocks, to buy this bond, etc. And the objective, of course, is to help you to make money. And if it works, then later on, of course, the return go back to the investors. Okay, that is the idea. So instead of just doing the job yourself, choosing which stock to buy, etc., you trust a fund manager to do it for you. But the fund manager doesn't just service you, but he services everybody who buys the fund. Okay, so it's kind of a common scheme, and by doing that, it's saving money, because it's not a customized one by one, but it's for everybody, and therefore it's like wholesale product. It's not customized to you, but it will save money because it's working for everybody. Okay, so that is the idea. And also note that a mutual fund is actually a company. So meaning that it has to do a reporting, annual reports, etc., same as a company. So that's why we have all those reports, because it has same constraint as a company. And then, so what kind of things the fund manager can buy? Well, he can buy stocks or equity, for example, or all the stock that are listed. He can buy some government bonds, and he can buy, he can also lend out the money, etc. So there's many ways he can do. Okay, so, and according to what he does, he will he might return different type of profit. Maybe positive, but it can actually can even lose money. Of course, it's not guaranteed that he will make money. So, but all the thing that the fund manager will do will give different type of different type of results that would have to be disclosed, to the investors. Okay, so this is the fund report. This is what the report and prospectuses are for. So if you are not familiar about the mutual funds, for example, maybe you haven't heard about those names, but if you are, then those names are kind of giant of mutual funds. For example, Vanguard, okay, Vanguard, Fidelity, BlackRock, State Street, Invesco, T. Rowe Price, MSCI, Robeco, JP Morgan, of course, this is a bank, but all those guys, they have mutual funds for people to buy. And when I say mutual, they have $billion, like several billion, 100 billion of dollars. It's huge, okay? Because it collects the saving from everyone, like from everyone in the world, US, but also outside of US and etc. So, and those guys are huge, and they're actually moving the market. When they decide to buy something, you know, the stock can go up, or if they sell something, the stock will go down. And they will own some high percentage sometimes of some companies, and even control the companies because they are so big, you know. Okay, so so these are the companies that and later on, when you work on fund report, you are going to see many fund reports are coming from those companies. Okay, so you will get familiar with those names. So now there are some terms that are very important to know. And when we talk about funds, very often we are going to talk about those initials. Okay, so those names. First, AUM. Okay, AUM means asset under management. So meaning that how much money you manage it. So let's say, for example, you know, Vanguard, I don't know, maybe $100 billion of asset under management. Okay, so etc. So asset under management is how much money the company manage. It's and also sometimes it depends on the on different funds. This fund is how much. This fund is how much. Is the is asset per fund as well. Okay. NAV. When I talk about NAV, meaning net asset value. So this is for each fund. What is the value of the fund? So and divide by number of shares. Let's say, for example, if you have this fund, it is $1 billion in this fund, and there's 1,000 shares, then each share, the NAV is 1,000, because 1,000 divided by 1,000 is 1,000. Right? So 1 million divided by 1,000 is 1,000. So it's the NAV. NAV is the net value of the investment fund divided by the number of shares. Number of shares is, let's say if you have a fund, this fund, you create this fund with 1,000 shares, and then everybody can buy the 1 shares up to 1,000 shares. Okay, so this is the number of shares. So this is the NAV. And then the expense ratio. Expense ratio, this is how, because the fund is going to spend money, because you know, spend money by paying the fund manager, spend money by commission, trading, by maybe for marketing, etc. So all the expenses divide by the fund value. Okay, how much the asset is the expense ratio. Okay, so let's say, for example, suppose that this fund had is $1 billion. Okay, no, say $100 million. Suppose this one has $100 million, and every year the fund spend $1 million as expense. So the expense ratio is 1%, because 1% of 100 million is 1 million. Okay, so expense ratio is how much they spend per year for the fund. So of course, the higher the expense ratio, the less good it is, because you want to buy a fund that has low expense ratio, meaning that the fund is spend less money. So for example, if the fund pay the fund manager a lot of money, because you know the fund manager is a superstar and he wants to pay a huge salary, and then that would be bad for the expense ratio. If the fund, for example, he pays a lot of commission to brokers, etc., then for trading, then that's bad for the expense ratio. If the fund do a lot of marketing, you know, they spend for advertisement, etc., then it's also bad for the expense ratio, etc. So all the expenses will make the expense ratio go higher. So the higher the expense ratio, the less good it is for the investor. Suppose that your expense ratio is 1%, and your fund at the end of the year is making plus 1%, but if you minus the expense ratio, at the end it's 0, right? The expense ratio will make it gone. So expense ratio is very important for a fund, because you want the fund to be as low as possible. Okay, but it will never be 0, because expense ratio necessary. You have to pay the fund manager. You have to pay a lot of things, so it will never 0. But there will be some numbers, and the lower the better. Now, one thing that is very important is for a fund, how much the costs. Okay, so when you buy a fund as a retail investors, okay, so when I say retail investor, okay, I mean like like you and me, the average people. Okay, so that is opposed to institutional investor. So institutional investors, they are not retail investors. They are, for example, like pension fund, government organization, university saving fund, or all saving, etc. So those are not retail investors, and we call them institutional investors, and those are big, like big size. Okay, but retail investors are small size. So the charges is actually different for retail investors or for institutional investors. So here I'm talking about for retail investors, for example. So when you buy a fund, first thing you have to do, you have to pay the upfront fees. Upfront fees like loading, they call it loading fees. So for example, if you buy the fund, they say, okay, you have to pay 3% to buy this fund. So when you put $100, you already lose $3 immediately, like you only 97. But of course, you hope that you keep it for a long time, and then after a few years, then of course you make it back because your fund is going to make money. Okay, so upfront fee go against you, but usually the upfront fee is never zero. Okay, but some fund might, for example, might give zero for institutional investors. For example, Insto investors, maybe they get zero because they are big and they got discount. Okay, upfront fee usually is high for retail investors, but maybe there are some special condition where they will charge you upfront fee zero. But if they charge you zero, probably they will charge you a fee somewhere else. Okay, so the second type of fee is management fees. So management fee, this is when, of course, the fund manager needs to be pay his salary, right? So this is management fees. So it's to pay the funds, is to pay the fund manager. But the fund manager, maybe he will use back office, for example, and he will use some system like XQuant system. He will pay XQuant. So all the expenses will go inside the management fees, right? And he will so all this. Same thing, management fee is never zero. Okay, it's going to be some fees. The higher, the more expensive is the fund. Okay. Next one is performance fees. So not all the funds do that, but some funds, they say if they make money, they will get to take a percentage of this money. It's like, okay, I help you to make money, but you have to give me 20%, or you have to give me 10%, or etc. So this is called performance fees. But if you lose money, if they lose money for you, of course, they don't pay you back, and this is for you, okay? You take 100% of the loss, but you only make 80% or 90% of the gain. And the difference is performance fee. So it's great, right, to be a fund manager. So this is it's not symmetrical. So this is also sometimes applies, not always. The next one is exit fee, and when you're selling it, also you have to pay a percentage, okay? With sometimes called unwinding fee or exit fees. Exit fees, sometimes there's no exit fee. Sometimes people say, okay, you pay high upfront fees, but no exit fees, for example, something like that. Or something like, or people might say, okay, you pay nothing upfront fees, but later on you pay big exit fee. But in either way, you cannot escape. Most of the time, you will pay upfront fee, but no exit fee. Okay, more often, because they prefer to take money immediately rather than take money later. And then there's in the USA, there's something that they call 12B1 fees. That is some distribution for marketing, etc. That's all the fees. But anyway, so all those fees will just add up. Okay, so all these charges are very important because at the end, you will impact a lot your real earning. If, for example, you invest into a fund and the fund is making 5% after 1 year, but then after that, you minus management fee, maybe let's say 2%, okay, then 3% left. And then, but because initially upfront fee, you already pay 3%. So at the end, maybe even the fund make 5%, at the end, you are still zero, you still make nothing, okay? And also, as you can see, it's also encourage you to keep the fund for a long time. Because if you buy a fund and you sell it after 1 year, you buy another fund, you keep paying the upfront fee and exit fee, right? So usually mutual funds is for for you to keep for several years, not just buy it and sell it after 6 months or after 1 year, okay? Because otherwise, if you do that, you are going to pay a lot of upfront fees or exit fees, okay? But some funds, they have very low upfront fee and very low exit fee. Then those funds are usually better to keep short term. But the fund that are high upfront fees or high exit fees, then they are usually good to keep long time. So and then you might ask them why some fund charge high and some fund charge low. Well, because there are some fund they are very popular. They are managed by some famous fund manager who was keep making money, and then they will charge more. For example, there are some fund manager, they are well known being the genius and always make money, and everybody wants to buy them, and therefore they can afford to charge more. Okay, so that are the charges. So very important part of the funds. And then the funds are in the USA. So this is for the US. The fund, they have different classes. So what is the classes? Basically, this is for the classes are for different type of investors. It's the same fund. It's the same fund, but according to the type of people who are buying, maybe they will make different conditions of fee or different conditions of exit fee, etc. Okay, so for example, in the USA, the Class A shares, this is for they are charged upfront fees, but they have low expense ratio. So this is good for long term because you pay a lot of upfront. So if you just short term, you buy and sell, you lose upfront too much. So this is not good for short term, good for long term. Okay, but because you have a low expense ratio, and this expense ratio is every year. Therefore, if you could keep long term, it's good. If you could short term, high expense ratio not so important because it's just keep for short term, right? Then the A shares also have for some big investors, then the upfront can be lower, like institutional investors or high net worth, they would charge less upfront fee, like negotiable. You get a big discount for once again. You have another called Class C. The Class C, this one is high expense ratio. Okay, so but small exit fee, and so this one then probably is more short term, right? Because the expense ratio is high, and if you don't keep long term, it's okay. You want exit fee to be small, like the upfront exit fee to be small. So that's why Class C is popular for retail investors. Okay, short term. Then you have the Class I. Class I, this is for institutional investors. Class T, this is low cost shares. Low cost, meaning everything's low. Maybe Class F, this is for fee-based investors. So there are. So the meaning of this is sometimes when you buy a fund, you don't buy yourself, right? There are somebody recommend you to buy the shares. The guy who recommend you is advisor, and sometimes the advisor also receive a commission. So you not only you pay the upfront fee, but you also pay the commission to the advisor. But sometimes, let's say a guy from BNP Paribas call you and say, okay, I want you to buy a BNP fund. And of course, he's a BNP Paribas guy, so he wants you to buy the BNP fund. So there's a conflict of interest because the guy works for the bank. If a bank call you, let's say I'm from Biet and want you to buy a Biet fund, of course, he's working for Biet and he will say, oh, the Biet fund are the best. So this is a conflict of interest. So that's why sometimes it's good to use an advisor because this advisor, they are third party. So they don't work for any bank, etc. They just work to find the best investment for you. Okay, so these are the advisors, and so the advisors ensure that there's no conflict of interest, but you have to pay them. Okay, well, supposedly, but maybe they still advise you some fund that they're like the advisors, they are like influencers, on the internet. They tell you this is good to buy, but you're not really sure if they are not biased or if they are sponsored behind. We don't know. But anyway, so but supposedly a good one will give you good advice. Then there's something called class 5 to 9. This is for education. Sometimes people save money for children's education later on. You know, they have some tax impact. You know, so this is 5 to 9. This is all for the US. This is all for the USA. And something also they call class R. This is for retirement. Okay, so this is very long-term investment, and that is good because I suppose you have some low tax as well. So all those classes are actually for one fund, meaning that the fund manager, he managed the whole fund for everybody, for all the class together. But after that, you can buy the class A, you can buy class C, class I, etc., depending on what's the use of those your investment, and according to different class, you are going to get charged different type of fees. Okay, but the performance will be the same. Okay, performance before charges, before cost, because it's the same the same fund managed by the same fund manager. Okay, is it clear until now? Is there any question first, before I continue? Okay, or if not, just you can ask me later on. Okay, so I continue. So now these are all the very important characteristics of a fund. Okay, so if you buy a fund, what do you have to look for? Basically, so inside the prospectus, inside what kind of information they are going to tell you. So first thing is fund managers. Who are the fund managers? So this is important because there are some famous fund managers. They are good, and then they have a good track record, and you can trust them. You know that if you trust them with their money over a long period of time, they are going to do better than other guys. Okay, so maybe, but there are some other fund managers. They are very young. They have no track record. So maybe they are good as well, but you don't know because they have no track record. But some of them, they have already been there for 20 years, and you know that they have good track record, etc. So knowing the fund manager is very important. The fund will disclose who are the fund managers. Is it one guy? Is it a team of 5 guys? Etc. Next one is the investment objective. So the fund, what is the objective of the fund? Is it to capital gain? For example, we do the fund, we invest into some stocks which potentially can go up a lot in the future. Or is it to get dividend? Some stocks, they don't go up a lot, but they are very stable, but they have good dividend. Okay, so this is for distribution. So it's different objective. So the fund manager, we have to declare, okay, what is the fund objective for and then you will choose. If some people, for example, if you don't want to take risk, but you just want to have a very safe, then maybe you want to take a fund that is not M capital appreciation, but to M yield. It's going to get you maybe let's say 2%, 5% every year very safely, but the capital appreciation will be very, very little. Whereas some other funds, the capital appreciation can be potentially very high, but also risky, okay? And maybe give no yield. For example, if you invest into Google, Amazon, and all those high growth stocks, typically those stocks, they give no yield because they're actually even losing money, so they are not going to pay you any dividend. But they keep going higher because the stock price going higher because through the growth. Okay, so this is capital appreciation. So the investment objective is different according to what you buy. Next is investment strategy. So meaning that what is the approach of the fund manager? Is it going to buy, for example, let's say growth stocks or the tech stocks, high-tech stocks, or maybe some bank or financial sectors, and etc. So what is his strategy? He's going to disclose. Okay, so and the fund manager, we have to stick to it because this is the type of fund, and that's why you buy this fund, because you like the strategy. Okay, and you believe. For example, let's say suppose that you like tech stocks. Okay, and there's a fund called tech tech funds. So then you buy this fund, and then the fund we measure, we essentially invest into the tech stocks, or you like an ESG fund. Okay, so then the investment strategy is to give priority to good ESG companies, and then so the fund manager will have to stick to that, and that's why you buy it, because you like an ESG fund, and therefore the ESG investment. This is a strategy. Okay, so there's different type of approach. So this is the this is also be disclosed, and the fund manager will have to stick to it in the prospectus. So next, this is the risk. Okay, so the fund has to disclose what kind of risk is it. For example, they invest into some bond that is that is very safe, or maybe they invest into some Russian bond that is very risky, or some bond of emerging markets. Okay, then the credit rating will be low. Sometimes they have a good diversification. Okay, so many different sectors, but sometimes they don't have, and they are concentrated into one sector specifically. Okay, but it's a choice, but they have to disclose it. Okay, so sometimes they invest into a lot of equity, a little bit only the bond, so this is risky. Sometimes it's just a little bit of the equity, but a lot of the bond, so safer, etc., etc. So this is all the risk that has to disclose. Next is asset allocation. So meaning that the money that the fund manager has, how they're allocated. For example, which sector is it? Is it a food sector? Is it the healthcare sector? Is it biotech? Is it etc.? So this is the different sector of the industry that they concentrate. How much they put in the USA? How much they put in Brazil? How much they put in China, etc. So geographic allocation, and even they have to disclose. For example, what are the top holdings? Okay, the top holding is Apple, is Amazon, is etc. So the top holding stocks that they have also disclosed. Next is the portfolio turnover. So meaning that how often they buy and sell. Okay, for example, some fund manager, they buy it and then they keep it forever. Some fund manager, they buy it and then they will, after 2 months, they will sell it and they take another one. Okay, so then high turnover. Okay, so the turnover is basically how much money you buy and sell from your total money. If for example, a fund has a turnover of 20%, it means that 20% of the money has been buy and sold during the year. Okay, so the turnover is of course never zero, because obviously the fund manager have to adjust his portfolio during the year. For example, during the year he's reading the bad news or good news. Something has changed. Then he will sell the stocks and buy a new one, etc. So that will create turnover. Okay, so the higher is turnover, it means that the more the fund manager is actively, rotating his portfolio. Okay, if you have a turnover of 100%, it means that for 1 year the fund manager has 100% of the money sold. He sold everything. He bought everything back, almost like on average. Okay, so and high portfolio turnover means necessarily also high fees, because when you buy in and out, you are going to pay commission, right? So high portfolio turnover will correlate later on high fees necessary. Okay, so next, so this is the fees. So this is how much the fund is paying. So yeah, of course, as I mentioned before, it's linked to the portfolio turnover. The fees also may be linked to any other stuff like expenses, etc. Next thing is the performance. So performance is the past record. Okay, so for example, when you buy a fund, the fund will disclose previous year. Okay, unless this fund is just started. So if the fund started new fund, then there'll be no history. Okay, so then it's not everything is new. Then there's nothing to say. But if the fund already exists after 5 years, then how about the previous year? How much money they made? Was it up 5%, up 10%? So year by year, how much was the fund up? Okay, so the past performance can let you think about what would be the future performance, okay? But not necessarily true, but if you see that the fund has a good performance over the past, maybe you can think that, okay, it can continue. But whereas if you see a fund has a lousy performance, just minus every year, then okay, this fund is hopeless, you know, you're not going to buy. So this is a performance that has to be disclosed also in the prospectus, okay? Next thing is the maximum drawdown. So this is very, this is also quite an important concept. The drawdown is when you lose money, okay, from the top. So let's say, for example, the fund is up 5%, okay? Another year, a year after, now he's up 10% in total. Then after 5 years, the fund is supposed is up 50% in total. He has a good year. But then a year later, now he lose 10%, he lose 20%. Okay, so lose 20%. And then after that, he's up again. So this 20% is a drawdown. So drawdown is going down from the top. Okay, because the fund never go up in a straight line, they will always sometimes go down, right? You must have some bad year. So the drawdown is measure how much you go down on the bad years. So if you have 2 bad years in a row, then it's drawdown, so total. So maybe your maximum drawdown will be 50%. So meaning that you lose 15% from the top. Okay, it doesn't mean it's bad, but the more drawdown, it means that usually it means that your gain is gone. Right? Your gain is has been gone partially. Then after that, it might go up again. Okay, so the maximum, we measure the maximum drawdown of the fund. The higher the maximum drawdown, the more risky, because maybe this can happen again. Okay, so this is on the past. Minimum investment. So for each fund, there's a minimum investment. Okay, because you cannot buy just for $100, obviously. So some funds say minimum is $1,000. Some fund have actually some fund maybe no even minimum investment, only very like $100. But some fund minimum is $100,000, so very big. Okay, so it depends. So why there's something like that? Because some fund they don't want to have too many small investors. They prefer to have a big investor. So they will set up a high minimum investment to avoid having plenty of small investors, to keep just maybe the rich guy. Okay, so whereas some fund they target everybody, and all the saving from the household, etc. And then they put very, very low minimum investment so that anyone can invest. Next is distribution policy. Okay, distribution policy. Sorry, I see a typo. Okay, so distribution policy is when, for example, the fund, is it paying, we paying the dividend to you or not? Because some fund, they don't pay dividend, but the dividend is reinvested. Like suppose like the fund have some stocks, but the stocks, once they get it, once they get the dividend, they use it to buy more stocks. Okay, this is reinvested. So some people, they don't want to receive money. They just, okay, if you make money, just put the money back in and make it bigger because I don't need money. Whereas some other people, they say, okay, no, this fund, I need it to give me some money every year because for my living. So therefore I want the dividend to be distributed. So this is a distribution. Okay, so it depends on what you need. Sales status. So some fund, they are still open, meaning that you can keep buying, whereas some fund is closed. So when the fund is closed, you cannot buy anymore, meaning that they sold out, and they don't want to take more. Okay, it happens. Why they're doing that? Because the fund manager doesn't like too big. Because if it starts to be too big, their strategy doesn't work anymore. Okay, so suppose that there's a fund that his strategy is to invest into some very small illiquid stocks. Okay, the fund manager, he's going to find some stocks that are illiquid and small, and then he buy it. But he cannot be in big size. So this fund, maybe he said, okay, my fund is maximum $100 million. If I get $100 million, my fund is closed. Okay, so no more buyer, because I don't think, because he doesn't think that with more money he can do as good. So this fund is closed. Okay, but some fund, they have no limit because it's huge. You know, their investment can be scaled up for infinite. So therefore, it's keep open, and then people can keep buying. Okay, the last thing is benchmark. So benchmark is when you look at the fund performance, you want to compare the fund to another fund or to a benchmark to see if the fund is doing well. Say, for example, suppose that the market is very good and everybody's making money. So if you make 5%, is it good or bad? Actually, it depends. If everybody making 10% and you make 5%, it's not good, right? And if the market is crash and everybody lose 20%, but you only lose 5%, then you are good. Okay, so this is all relative. So that's why, in order to judge if fund is doing good, well or not well, we actually compare to a benchmark. And the fund, sometimes they choose a benchmark. They say, okay, my benchmark is the S&P 500, for example. Okay, so if they are do better than S&P 500, then they're doing a good job. Okay, so basically, if you are and if they are doing less, then basically it's useless, because then why do I waste my money to buy? I can just buy something that is passive and following S&P 500. Right? So that's the benchmark, and so there are different type of benchmark. For example, let's say ESG fund. Maybe there's a ESG, maybe there's MSCI ESG index, and then the benchmark, this ESG fund will follow the ESG index. He's not going to follow the S&P because it's an ESG fund. It doesn't make sense to follow S&P 500. He's going to follow ESG index because ESG index might behave differently. And then if the fund beats the ESG index as an ESG fund, then it does a good job. Okay, so that's it. I think I went through all the important points. Now, next thing I like to do is I'm going to take some samples of the fund report, like that we receive. Okay, I found, and then look at them together. Okay, so okay, so maybe before I go to this step, is there any question somebody want to ask about what I've said until now? Hello, any questions, or is it clear?
Until now it's clear, but we should test it on some term sheet.
Okay. So if you don't have a question, I'm going to continue. And now I'm going to look at the some fund report. Okay. So what I'm going to look at is it's something that is simpler. Is the summary, prospectus, and fact sheet. This is the one that you have in the share drive. Okay, so let's say, for example, this one. Let's look at the first one, Fidelity. Okay. Once again, make it bigger. Okay, so let's go from the beginning. So Fidelity Target International Equity Fund, Fidelity Japan Fund. Okay, class, ticker. So this is here, the class here, Fidelity Japan Fund. This is his class. I think this is internal classification by Fidelity. This is the name. Okay, they call it Fidelity Japan Fund, whatever. Ticker. So this ticker, this one is the official ticker on the US stock exchange, FJPNX. So this one you can look at Yahoo, you can look at Bloomberg. You are going to find it. Okay, through this one. It's listed FJPNX. Okay, so summary prospectus, December. Okay, the date. This one is a disclaimer, so we don't care. Okay, here you see investment objective. Okay, it says the fund seeks long-term growth of capital, long-term growth. Okay, so this is clear. Fee table. So this is how much charge. So they say, okay, fee table. There's a table here. The table, he says the following table. So I think this is his table. So you have the 0.85%, of management fee. Okay, so this is to pay the fund manager, to pay the distribution fee. There's no distribution fee. All the expenses total one. Okay, so these are the fees. Still, so then they give an example. If you put $10,000, if you put $10,000 for the first year, how much money you pay? $115, etc. So this is the example. This is, but actually this is coming from this formula. So it's kind of redundant. You don't need that, but for sometimes in order to for people to for the retail investor when they read it, okay, you can guess if you $10,000 how much you pay. Yeah? Okay, but you can see that 1.13% of $10,000 is $133, right? Look, it's about the same. Okay. So here portfolio turnover, I mentioned about it. How much. So here it says the portfolio turnover is 26%. You see, so it means that over 1 year, the fund manager he sold and 26% of the portfolio, like both sold and bought. Okay, and then you have foreign exposure, for example, is it U.S. markets, for example, is etc. Geographic concentration, but because this is a Japanese fund, so obviously they must have a lot of Japanese stocks. And then they have the performance. So this is the performance. Okay, this fund is very old. You see, you can see back to 2012. I don't know is there anything before 2012, but at least it started. So it was up 9%, up 23, down 8, etc., down 14, etc. Right? So if you look at this fund, the maximum drawdown is here, 14.3%, because this is when he's down. He has never been like, he was down only 2 years, 2014, 2018, and here, this year is the maximum drawdown. Okay, unless there's something before 2012, which we don't know. I don't know when this fund started. Return. Oh, I think what's year to date return minus 34, 2022. Oh yeah, because you see, look, so this is very tricky because typically, the fund, they are very cunning. For example, here they don't show it 2022, right? It stopped here. So, but actually the date here is December. Okay, it's year end. I think they could have shown 2022, but they didn't. But if you look closely, year-to-date return minus 30. So the maximum drawdown is actually minus 30, not 14. So you see, if you don't look closely, you say, oh yeah, not bad, but actually it's very bad. The 2022, they are down 30%. Okay, but they didn't show on the chart here. Okay, annual return.
So sorry, but this one is it will be like complicated in extraction after that.
Yeah,
you
mean.
It will not depend only on chart, but also
yeah.
like in chart sentences and paragraph.
Yeah, exactly. But here, maybe they can. Well, we extract what they show, because maybe here they said that the year is not finished, right? Because their policy, they can say our policy is to put on the chart only a year after, because we have to wait until we got all the numbers. So you don't know. Anyway, this is the way they do, whatever. So they also report quarter ended September, actually. So that's why it's not December, because maybe they don't have the December number yet. In December, maybe it's even worse, right? Because December 30, they don't have it yet, because they made this report December 30. So it's 3 months, still 3 months late. That's why it's 30%. Okay, so it's not intentional, but maybe they don't have the number. That's why they cannot report. Okay. Anyway, so then you have some return. There's a table here, past 1 year, 2 years, different return, etc. Here they disclose who are the advisors, the name of the advisors, people who can sell the fund for them. Here's the name of the portfolio manager. His name is Kurt. Numerator, just one guy, and he has managed a fund since 2014. Okay, so which means that here is not him. So from here is him. Okay, so this is somebody else. And here, okay, and all the type of information, text information, etc. Anyway, so all right, okay, so this is one type, this is one report. Let's have a look at another one. Okay, this one. So this one, Aditya Birla Sun Life, so sounds like Indian fund. Yeah, you see, it's a benchmark Nifty. That's India. Okay, so so this is the benchmark. This is the index. Okay, Nifty banking index. It's probably this fund is probably a bank fund with invest into some financial stocks. So they use the Nifty banking index as a benchmark. Okay, you have the rating, with 3-star by Morningstar. Okay, and then you have the fund performance since 2017. Okay, so so this is the fund. This is the benchmark. Actually, the green is the benchmark. The fund. So the fund is actually not good. He keep underperforming the benchmark. Oh, actually no, I don't understand because there's one jump here. The benchmark is strange because I don't know why it's a jump. But anyway, it seems to be very stable. Okay, very stable. It doesn't make much. So it makes what he did. He started 10,000, then he finished 12,000 or 13,000. So he made 30%, right? 10,000, he makes 30% from 2017 to 2020, so in 5 years, 6 years. So 30 per 6 years, meaning 5% per year. Okay, 5% per year, you see? So, but 5% per year for India is not great because Indian interest rate is quite high. And I would say this very average fund. Okay, so that's how I analyze it. Okay. So risk. So here, this is a little bit complicated. Okay, so today I don't have time to explain, but they explain what is alpha, the beta, the Sharpe ratio, standard deviation, etc. So this is tracking error. So this is a bit complicated, financial terms. So I don't have time to explain. But this is some people were able to read this, okay, to know it's good or bad. Asset allocation, you see, for example, everything is mostly bond. You see, it's clearly 74%. That's, you see, the only bond. That's why it's so stable, because it doesn't have any equity. And just hold cash. No doubt. Okay, so here, fixed income. So they make this is typically a Morningstar chart. Here they show you is it low, moderate, or extended, high, mid, low, etc. So in this square meaning high credit, and the interest rate is low, the sensitivity. So basically not very safe. This in this corner means it's something very safe. Okay. Look, 95% of the fund is AAA, meaning very safe. Okay. And the stocks that the bond is duration, for example, here, meaning that they invest into some bond that is about 1.8 year of life. Okay. On average. So 43% is corporate bond, 47% is government bond, 43, 47. Coupon range. Top asset holdings, 21% is I don't know. Number of bonds, so 184 bonds. So they have plenty of bonds, different type line, 184. So they don't disclose because no space, but this is summary. But you see, there's 184 type of bonds, different. Okay, and then you have the expense ratio. You see here, remember when I mentioned expense ratio? Okay, 0.7%. Exit low, so 0. So no exit. You don't pay anything when you exit. But there's a minimum initial money minimum purchase is 1,000 rupee. 1,000 rupees is very small. It's no NAV. Okay, NAV here, you see, NAV is 100, 111. So meaning that the fund, one unit of the fund is cost 111. If let's say if I want to buy 10 unit, then it will cost me 1,000 rupee. Okay, and the total asset here is 83 million rupee. No, it's 83 billion rupee. Okay, because this is million, so 83 billion rupee. All right. Okay, so that is for this one. I don't know. Let me open another one. Okay. Okay, so this one, Blu-ray USO, this one is managed by Royal Bank of Canada. Okay, RBC. So you can see Canada, a Canadian fund. Here, investment objective here. So so you see that now this expression to provide total return. So this one is mostly interest. You see, interest income and modest capital appreciation. So not much capital appreciation like the other fund, but mostly interest. So this fund is rather safe because just pay interest, not much capital. So the fund invests primarily in high yield debt, so just yield, okay, because you get distributions. So fund performance. So this fund actually is quite new because it has nothing. Only started in 2021, it seems, and then it didn't do well because because I think recently interest rate go higher, right? The Fed. So in all the bond, they're not doing well because when interest rate go higher, the fund lose money. Right? No more. You see, he lost 10%. And he sees portfolio analysis, asset allocation, cash 10%, mostly fixed income 89%, etc. So benchmark, you see, so this fund follow this benchmark called ICE, Bank of America Global High Yield Index, and okay, this is the benchmark it follows. It distribute every quarter, distribute a dividend. It's open, meaning you can keep buying, minimum $500 Canadian dollar, I presume. And then after that, so initial investment 500, then later on, 25 minimum dollar. So it's very cheap, like anyone can buy. Right? And the risk is low risk, okay, as I expected. And then this is considered a no loading structure, meaning that when you initially buy, you pay nothing. NAV is $7, so meaning that one unit is $7. And this fund is $272 million total asset, okay? It started 2021, it's very new. Okay, so anyway, okay, I'm going to stop here, okay? So this is all the fund inside the summary and prospectus fact sheet. So I think now, after today's my explanation, if you look at those reports, now I probably you understand more, okay? And then next stage, okay, we are going to think about what to extract, etc. But maybe today you probably have some idea already how to do what to extract. But now how to do it, that's a different story. Okay, so is there any questions? Is it all clear? All right, okay, so it's been just 1 hour, okay, perfect. So if you have no question, I'm going to finish the presentation here. And of course, tomorrow, when we have the meeting, we can talk again, okay? All right, okay. Good.
Okay.
Thank you very much. Thank you, everyone.
Thank you.
Okay, bye.
Thank you.
Bye-bye.